Okay, let's dive into this. For decades, if you needed, say, a new winter coat, school clothes for the kids, or honestly just a fresh set of towels, there was really only one place you almost certainly went: Penney. I mean, they were an absolute titan of American retail, this massive, seemingly untouchable staple anchoring practically every mall in the country. But today, we're not talking about their peak. We're actually unpacking a fascinating and quite frankly tragic business story. We're going to look at exactly how one of the most trusted names in retail completely fell from grace, driven by intense margin erosion and a truly catastrophic misunderstanding of retail psychology.
Which brings us right to the core mystery of today's explainer. How does a retail giant accidentally destroy its own customer loyalty? You see, this wasn't an overnight disaster. It was essentially a perfect storm of rising competition, shifting consumer behavior, and frankly, a few incredibly hubristic strategic decisions that permanently changed how customers experience the brand. The stakes literally couldn't have been higher, and yet, the collapse happened right in front of our eyes.
To truly understand the fall, we have to look back at the rise. Section 1. The Retail Giant's Golden Era. For middle-income consumers, Penney had cracked the absolute winning formula. They offered frequent promotions, deeply attractive discount pricing, an incredible variety all under one roof, and a totally familiar, comforting shopping experience. Heading to Penney on a Saturday morning with a freshly clipped coupon in your hand wasn't just an errand, it was a routine. It was deeply ingrained in a family's weekly behavior. Consumers expected unbeatable value, and Penney consistently, reliably delivered it. But here is the real secret sauce behind that golden era. Sales and coupons were not just marketing tools to clear out old inventory. They actually became a core part of the customer's identity. Shoppers felt a profound psychological attachment to this discount pricing culture. Think about the thrill of the hunt, the absolute satisfaction of getting up to the register and scoring 50% off your total. That was Penney's superpower. It wasn't just about buying a shirt. It was about the rush of getting a fantastic deal.
But as we know, nothing lasts forever, especially in business. Section 2. A brutal new retail world.
And this brilliantly illustrates what happened next. The landscape didn't just shift, it fractured violently. The traditional playbook became obsolete basically overnight. In the old days, Penney really only had to worry about traditional rivals, the other familiar department stores right across the mall corridor. But suddenly, a massive, multi-headed new threat emerged. Amazon created absolute price transparency. Fast fashion brands accelerated trends to breakneck speeds. Target and Walmart aggressively gobbled up those price-sensitive shoppers. The brand was suddenly under this intense, multi-directional pressure that completely and permanently changed what consumers considered convenient.
Faced with all this pressure, management believed they had to drastically modernize just to survive. Which leads us to Section 3, the fatal pricing mistake.
So, management looked at their old model of endless discounts, direct mailer coupons, and weekend blowout sales and thought, well, this is exhausting. It's confusing. So they made a massive, sweeping pivot. They shifted the entire business to a straightforward, everyday pricing model. No more constant sales, no more clip and coupons. Just fair, consistent prices across the board, all the time. Now, from a boardroom perspective, this sounded incredibly logical, right? It simplified operations dramatically. But out in the real world, it was an absolute disaster.
The core problem here was beautifully simple. Pricing is emotional, not purely mathematical. Penney fundamentally underestimated how deeply their discount culture shaped customer behavior. Even if the final price of a sweater under the new everyday pricing was exactly the same as it used to be with a 20% off coupon, the customer simply did not feel the same. The thrill was completely gone. Management essentially stripped away the very promotions that made shopping there fun, and those loyal customers, they simply walked right out the door.
When those promotion-loving customers vanished, the financial consequences were immediate and severe. Section 4. The Margin Erosion Spiral.
So the crucial point is understanding how the math of retail turns incredibly tense here. Margin erosion is the gradual decline in a company's profitability when the cost of doing business remains incredibly high, but competitive pressure, or in this case, plunging sales, forces you to slash your prices. It's a terrifying financial trap. It literally slowly closes in on a company, squeezing the life out of its profitability over time.
You see, a massive store network like Penney carries enormous high fixed costs. We are talking about rent for massive mall anchor spaces, staffing tens of thousands of employees across the country, buying inventory months and months in advance, and managing insanely complex supply chains. And here's the kicker. These costs do not shrink just because fewer people are walking through the front doors. So when sales weaken, profitability doesn't just take a little dip. It deteriorates dangerously fast.
Let's move to and see how this builds into an absolute nightmare scenario, a true retail death spiral. Step 1, lower sales force the company into a panic. Step 2, they desperately return to heavier promotions just to get people back in the door. Step 3, those heavy panicked discounts absolutely slash their profit margins. Step 4, reduced margins mean significantly weaker financial flexibility. They are bleeding cash at every single step, leaving them with less and less money to actually fix the underlying root problems.
And while the math behind the scenes was failing, the brand itself was fracturing in the public eye. Section 5, a dangerous identity crisis.
In the eyes of the everyday consumer, JCPenney started suffering from a severe split personality. When shoppers looked at the brand, they literally no longer knew what it was. Were they still a discount retailer? Were they trying to be some sort of modern, upscale lifestyle brand? A traditional department store? A fast fashion hub? The market had absolutely no idea. And let me tell you, when your positioning becomes this unclear in a hyper-competitive space, customer loyalty evaporates almost instantly.
Because the harsh reality of the business world is this: retailers must give customers a strong, undeniable reason to choose them repeatedly. When your identity is lost, customers have plenty of alternatives, like Amazon and Target. They don't have to wait around for you to figure out who you are. Once that trust and that deeply ingrained weekend routine are broken, rebuilding it takes years, if it ever happens at all. So, taking a step back, what does this all mean? Section 6, the ultimate strategic lesson.
Let's zoom out and look at why retail turnarounds are notoriously difficult. It boils down to the monumental challenge of trying to transform absolutely everything at once. To fix JCPenney, management was trying to overhaul pricing, remodel store designs, completely alter their inventory, pivot their entire marketing strategy, reset customer expectations, upgrade digital systems, and fix supply chains, all at the exact same time. It's literally like trying to rebuild an airplane mid-flight while the engines are failing. You have to modernize all these moving parts simultaneously while somehow protecting the day-to-day profitability, which, as we already know, was rapidly eroding.
Which brings us to the deepest takeaway of this entire explainer. Changing a business model without fully understanding customer expectations can actually accelerate a decline instead of a recovery. The fatal wound for JCPenney wasn't just Amazon, it wasn't just Walmart, it was the lethal interaction between intense outside competitive pressure, massive internal strategic overhauls, and fundamentally misjudging how their own customers behaved emotionally.
And that leaves us with a critical question to ponder. If a historic, multi-billion-dollar brand can collapse simply by misjudging human behavior and the emotional thrill of a coupon, do you really know what your customers want? It's a fascinating look at the psychological reality of consumerism and undeniable proof that, in business, the spreadsheet never tells the whole story. Thanks for joining me on this explainer, and I'll catch you